Is Target's massive $19 billion debt a hidden gem or a ticking time bomb? We've rigorously examined Target's liquidity risks, margin pressures, surprising valuation metrics, and uncovered critical strengths you'll want to see before your next investment move. Target Corporation, an established player since 1902, strategically divides revenue between physical retail and digital sales channels, operating nearly 2,000 store locations across the U.S. Its diversified merchandise portfolio, including perishables, apparel, electronics, and strategic in-store partnerships like Starbucks, reflects resilience yet exposes operations to consumer spending fluctuations. Target's balance sheet shows declining cash from $3.6 billion to $2.9 billion year over year, mainly due to lower earnings from operations and increased spending on long-term initiatives. Debt remains high at $19 billion, exceeding cash significantly, making tight liquidity management vital. Positively, the debt-to-equity ratio improved slightly to 1.3, indicating disciplined use of leverage, suggesting a cautious but strategic effort to balance financial risk with the ability to invest in continued growth. Here is a screenshot of the full balance sheet. Current assets exceed current liabilities, but growing inventory and higher long-term debt could pressure returns if sales soften. A proprietary Bow score reveals Target's strong preferred stock position versus peers, yet concerning weakness in debt and cash management compared to both industry and broader market. Examining Target's recent income statement raises caution. Net sales declined almost 3% as reduced consumer spending eroded comparable store metrics. Gross margins weakened slightly amid higher markdowns and rising supply chain expenses, suggesting profit pressures relative to rivals. Although operating margins notably improved largely due to favorable interchange fee settlements, investors should not mistake that as sustainable long-term. While profitability improved recently, the underlying retail environment remains challenging, potentially limiting Target's attractiveness as a durable value investment. Here is a screenshot of the full income statement. Beauty and advertising grew, but weaker household essentials and hardline swarmas dragged total sales lower. Mix improving yet flat credit card profit signals guest traffic softness. Target's operating margins outperform most industry peers, yet lag significantly compared to the broader market, emphasizing potential pressure on profitability in the highly competitive retail sector. Recent quarterly results reveal underlying weaknesses for Target, stemming from reduced customer traffic and weaker consumer confidence. Revenue dropped sharply to $24 billion in May, highlighting vulnerabilities to economic pressures. Although net income remains above $1 billion, the ongoing downward trend signals sustained operational stress. Investors should monitor management's efforts to stabilize revenue through targeted merchandising and pricing strategies carefully, assessing whether these measures sufficiently address competitive pressures compared to retail rivals. The sharp fall in Target's operating cash flow signals a concerning slowdown in sales paired with rising inventory, which management explains as inventory restocking for expected future demand. However, continued investment spending shows confidence in long-term growth. Although capital expenditures remain high, a value investor should closely monitor these cash pressures compared with industry averages, as consistently negative free cash flow or steep fluctuations may indicate heightened financial risk. Here is a screenshot of the cash flow statement. Operating cash fell to $275 million as inventory build and outflows drained liquidity, turning free cash negative and cutting cash reserves 1/5. Target's recent earnings raise some concern for value investors. Sales continue to decline as customers cut back spending, particularly on items they don't absolutely need. While the company's digital services grew substantially, highlighting promising online fulfillment capabilities, overall sales pressure remains significant. Management is proactively streamlining decision-making through the new Enterprise Acceleration Office, aiming to improve operational agility. However, uncertainties including weakening consumer confidence and potential tariffs present clear risks, suggesting investors should remain cautious about the near-term growth outlook. Analyst Forecast suggests cautious optimism, expecting Target's net income and earnings per share to grow modestly over the next several years. However, management acknowledges that achieving these figures hinges on navigating economic uncertainties, such as tariff impacts and shifting market conditions, making adaptability a crucial factor for investors assessing the reliability of these future projections. A proprietary Bow score shows Target significantly trailing peers and the broader market in net income and EPS metrics, indicating potential profitability concerns relative to competitors. Target's valuation metrics show a relatively lower price to earnings ratio compared to retail giants like Costco or Walmart, suggesting Target may currently be undervalued in market size. Yet its price to book ratio is higher than Dollar General, indicating investors value Target's assets more richly, presenting management with an opportunity to enhance strategic positioning and prove strong asset returns. Target's valuation looks attractive on earnings compared to industry peers, but its lower price to book score suggests potential concerns around asset value relative to competitors. The discounted cash flow valuation highlights Target's resilience and solid growth potential, with equity value estimates ranging widely under different scenarios. Optimistically, shares could significantly appreciate towards $189 each, while even in a pessimistic scenario, a baseline near $140 per share signals Target's ability to sustain stable returns amid market pressures. A proprietary Bow score indicates Target shows decent valuation strength against industry peers, but lags notably when compared to the broader S&P 500 companies overall. Analysts predict limited upside potential due to declining consumer activity, indicating that Target's cautious recovery expectations could pose investment risks if market conditions remain sluggish. A proprietary Bow score reveals Target ranks exceptionally high for analyst forecasts, outperforming all industry peers and 90% of companies in the broader market index. Target's $19 billion debt, paired with declining cash flow and weakening consumer spending, poses clear risks for prudent value investors. Yet, its improving leverage discipline, relatively low earnings valuation, and strategic digital growth initiatives suggest potential undervaluation opportunities if management effectively addresses core operational pressures moving forward. Make sure to watch another video from our Value Explorer series by clicking the playlist below.